Today we'll be focusing on the difference between the traditional IRA and the Roth IRA. We call it the battle of the tax advantage retirement plans. I'll discuss some of the high-level differences that make them unique, as well as what makes them similar, and then I'll give my personal opinion as to which one I think works best, given specific scenarios. So you've made your money, now what? Welcome to your virtual family office. My name is Teron Stokes. I'm the CEO here. Here on this channel, we spend time focusing primarily on how to master your money and how to build a legacy. Today, we'll be focusing on the difference between the traditional IRA and the Roth IRA. We call it the battle of the tax advantage retirement plans. So for those of you who don't know, the IRA stands for Individual Retirement Account, and that's going to be different than your qualified plan, which is going to be your 401k. If you work for a Fortune 500 company, this is a pretty popular retirement account that you hear about with the coveted match, i.e. free money. And so I'm gonna make it clear that's not what this video is about. This video is not about the 401k. That's gonna be for a separate one. This is gonna be for the IRA. This is an account that can be used even if you have a 401k, but this is gonna be wider reaching. Okay, so first things first, well, what is a traditional IRA? Looking at Investopedia, traditional IRA is a traditional individual retirement account that allows individuals to direct pre-tax income toward investments that can grow tax deferred. Now, tax deferred, that's a huge point that I definitely want to underline here, because that's one of the primary reasons why we're going to even get involved in this account in the first place. And it's important because if your money isn't being taxed as you put it away, it allows more money to be compounded over an extended period of time, which is how you really reap the benefits of this account. The IRS doesn't assess capital gains or dividend income tax until the beneficiary makes a withdrawal, and individual taxpayers can contribute 100% of earned compensation up to a specified maximum dollar amount. What's really saying is the government allows you to take income that you've received, and instead of paying them taxes right now, you pay them taxes later. Now, this is going to be important because, again, we're talking about time value of money, right? So if we allow more money to stay within a specified account or an investment vehicle and then compound it over an extended period of time, it leaves you with more money in the future. And so while it is tax deferred, it's not tax free. And so we have to make a very clear distinction when we're talking about the traditional IRA. You will at some point have to pay taxes on this when you start making withdrawals from the account. But for most of us, that's not going to be until somewhere off into the distant future. And so at which point, all that time, it's been growing, compounded, which makes it fantastic. Now, switching gears a bit, we're going to go over to the Roth IRA and talk about, well, what is a Roth IRA? And I'm going to come back to my handy dandy Investopedia. It's fantastic. I don't understand why you wouldn't want to use one. But similar to the traditional IRA, the Roth IRA is going to be another version of an individual retirement account that's used to save for retirement. The Roth IRA is a special type of tax advantage individual retirement account to which you can contribute after-tax dollars. Now remember, we're talking about the traditional IRA. The traditional IRA is pre-tax. Roth IRA is post-tax. In other words, you pay taxes at the onset once you put the money in. So after you've paid your taxes, you then go ahead and put it into the Roth IRA account, at which point the growth that you receive in that account will now be tax-free. That's a big difference between the traditional IRA. The traditional IRA, it does grow tax deferred, meaning you're paying taxes in the future. The Roth, you pay taxes up front. And so whatever growth that you receive, whatever appreciation that you receive in the account is now growing tax-free. So it's really kind of making a decision, do you want to take the tax hit up front, or do you want to take the taxes on the back end? We talked about what a traditional IRA is, what a traditional Roth is. We talked about why you would use it. Why? Because it's tax deferred or tax-free, it grows, as well as because it grows, this is an asset that you can potentially pass down to beneficiaries, allowing you to do two things that are very important on this channel. First of which is mastering your money. And then that's the second component, passing to beneficiaries, would be building a legacy. Now we're going to talk a little bit about who this account is for. Now, the cool thing about this is that either account you can have, even if you have what we call a qualified plan, if you're a participant in the qualified plan. So that's going to be like your 401k, for example. But the differences between the two accounts are going to be slight but important. But I do need to let you know, both accounts you're going to have what's called earned income. And so I'm going to take this directly from the IRS website. We're going to switch from Investopedia for a second. So according to the IRS, earned income is defined as Wages, salaries, tips, and other taxable employee pay. Employee pay is earned income only if it's taxable. Non-taxable employee pay, such as dependent care benefits, adoption benefits, and is not earned income. But there is an exception for non-taxable combat pay, which you can choose to include in your earned income, explained below. All that is to say that typically those who are being employed by someone, the employee, have earned income that can come from wages, tips, salaries. If you fit the box there, then one of these two accounts or both of these accounts are free for you to use. Another form of earned income is self-employment pay. And again, coming back to the IRS website, is net earnings from self-employment. You may have net earnings if you're self-employed, if you own your business, or you are the minister or member of a religious order. So that's still considered earned income, which enables you to use either of these accounts. Not mention this, but the traditional IRA allows you to put up to $6,500 into it, an additional $1,000 if you're 50 or older. In the Roth IRA, you'll be looking at $6,500 as 2023, an additional $1,000 we call a catch-up contribution if you're 50 and older. You still have access to a traditional IRA or a Roth IRA, even if you have a 401k. But now this starts to get a little bit hairy because now you have different income cutoffs if you're already participating in a qualified plan at work. We talked about the what, we talked about the why, we talked about the who, those who have earned income. And then we're going to talk about the how. So the how is going to be a little more detailed, so bear with me. It's going to be absolutely worth it. Starting, of course, with our favorite, the traditional IRA. And I say favorite lightly and jokingly because we don't know which one is a favorite yet. But the traditional IRA, that's going to be the one that does allow you to have what we call tax deductible contributions. Now that's a good one. And so this is going to be the one that allows you to, up to a certain limit, it's going to determine if what you put into your traditional IRA, you can then also deduct against your taxes. Meaning you're just shoveling money into this savings account without taxation at that point. Okay, so now we're going to talk about the different income limits when it comes to the different accounts, whether it's traditional or Roth IRA. Additionally, we're also going to talk about the qualified plan, whether you're a participant or not, and how that could potentially impact how much you can contribute. And this really comes back to for the traditional IRA, whether you will have tax deductible contributions, and then for the Roth IRA, it's going to determine whether you can contribute at all. The IRA deduction limits for 2023, according to the IRS, and again, this is based on your modified adjusted gross income on deductions if you're covered by a retirement plan at work. And so I'm just going to scroll here, but the high level overview is so long as you're making less than $73,000 and you're single, you will take 100% of that deduction. So remember, that's the $6,500 that we're talking about. You can take 100% of that deduction, pulls down the amount of money that you're going to pay the government today, and then go ahead and shovel that over to your retirement account. If you are married and you're filing jointly, if you make less than $116,000 a year, then you can then take the full tax deduction. However, if you fall between, you're married filing jointly, if you fall between $116,000 and $136,000 a year, and again, that's your modified adjusted gross income, then you start taking partial deductions. And that's a little nuanced, a little mathematically, but it's going to keep it high level. We'll dive deeper into another video about the math behind it, but I just want you to walk away with that. And if you make more than $136,000 a year, there's no deduction. However, that does not mean you cannot contribute to a traditional IRA. You can still contribute all the way up to, well, however much money you make. Just know that the contributions that you're making, you don't necessarily get to take full advantage of them in today's dollar in the case of having a tax deduction. What it is you put the money into the IRA and you can then benefit from the tax deferred status of that money while it grows off to the future. So switching gears, I'm going to come on to the Roth IRA. I'm going to come back to my favorite website here, and that's going to be the IRS website one more time. Check it out. But you should honestly, all jokes aside, you should become pretty familiar with the IRS website because a lot of the taxation information that's passed down through the Internal Revenue Code is then put here on the site for all of you to see. And it also gives you a good chance to stay, up to date to the different things, specifically when it comes to contributions, because that tends to change annually. Every year, There are changes, there can potentially be changes to the amount that you can contribute annually, so make sure to stay on top of that. But as we speak for the Roth IRA, if you're married filing jointly or a qualifying widow or widower, as long as you make less than $218,000 a year, you can contribute the full amount to the Roth. That's going to be the $6,500 plus the $1,000 if you're 50 and older, and that's again for the year 2023. Could potentially change in the future. And if you are single, you can contribute up to the limit, up to $138,000. Once you get above that, so between $138,000 and $153,000, you can take a reduced amount for the Roth. And once you make more than $153,000, you can no longer contribute to the Roth. Circling back, that same gap for the married couple is going to be between the $218,000 up to the $228,000. Whereas a partial deduction, if you make more than $228,000, there are no contributions allowed for you, but that's okay. There are ways around it. But then again, that's for another video. Now let's talk about how. And when I say how, is how do we access the money that's been growing over time? And so I'm pretty sure you can guess it by now. We're going to start with the traditional IRA. You have to think of these distributions, which ultimately that's what that is when you're pulling money from the account, as a qualified distribution or a non-qualified distribution. For that, the non-qualified, you would receive what's called a 10% penalty, as well as the taxation of the funds. And so depending on your tax bracket, you'd be talking about a significant amount of money. And the reason for that is the government wants to, well, the IRS specifically, the government in general, wants you to stay away from that money until it's time to actually retire, which is roughly around 65. Now, switching back over to the Roth IRA, there are what's called, again, qualified and non-qualified distributions. The Roth IRA is a little more interesting in that once you put the money into the Roth IRA, that initial contribution you can pull out tax-free because it's been taxed already. It's post-tax money that you're contributing to the account. However, after that money is in, any growth that you receive on that money, you can't pull out as a qualified distribution unless you are 59 and a half. They have to be taken after a 5-year holding period. Now, there are exceptions to this when you use money potentially for a first-time home buyer or any type of higher education expenses. Getting into all details and just getting us in the weeds, I just want to keep it high level here. Those different qualified distributions are allowed for the Roth, but the goal here is not necessarily to use them unless you have to. The benefit to using these tax-deferred and tax advantage accounts is the growth in that account. So you don't want to be pulling money out if you don't have to. So now we've reached to the end. We've talked about what tax deferred and advantage accounts are, who they're for, how you use them, why you should use them, all again at a very high level. Subsequent videos will go into the weeds if that's something you all are interested in. But I do want to leave you with a conclusion, and that being, well, it depends on which account. But I think the best way to think about which account works best for you is kind of giving a futuristic view, right? So the tax deferred account, the tax deferred nature of a traditional IRA allows you to put off paying taxes into the future. Think about it in terms of when the money is going to be taxed. A traditional IRA is going to tax you in the future. So if in the future you believe you're going to have a higher tax rate than you currently have, then I would go ahead and stay away from the traditional IRA. I would look at the Roth IRA, being that you paid your taxes today. You pay your taxes now, you don't have to pay taxes in the future, so long as you have qualified distributions. And again, that's going to come back to the 5-year rule as well as being 59 and a half, just to name a couple for the Roth IRA. And so I hope that helps. I hope that sheds some light into the different accounts that you have available for those of you that do have a 401k and those of you who do not have a 401k. You still have an opportunity to grow money in a tax advantaged way, as well as leave a legacy for the beneficiaries who are after you. I enjoyed making this video. I hope you all gained a high-level overview of the differences between the traditional IRA and the Roth IRA. Be sure to crush that subscribe button as well as hit the like, leave a comment. But until the next video, my name is Teron Stokes. This is your virtual family office, and here we focus on how to manage your money as well as how to build a legacy.